Good evening, welcome to the Hinduja Global Solution Limited Q4 and FY22 earnings conference call. From the senior management, we have with us today Mr. Partha Desarkar, Executive Director and Group CEO, and Mr. Srinivas Palakodeti, Global CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. Please note this conference is being recorded. I now hand the conference over to Mr. Snyder Albuquerque for Factor. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and a warm welcome to the Q4FY22 results conference call of Hinduja Global Solutions Limited. We are joined by Mr. Partha Desarkar, Executive Director and Group CEO, and Mr. Srinivas Palakodeti, Global CFO, to discuss the Q4 and FY22 results and the key developments during the period. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financials and operating performances, benefits and synergies of the company's strategies, future opportunities, and growth of the market of the company's services and solutions. Further, I would like to mention that some of the statements made in today's conference call may be forward-looking in nature and may involve risks and uncertainties. I would further like to mention that if there is a call drop during the course of today's conference call, please bear with the management. Thank you, and over to you, Partha, sir.
Good afternoon, Snyder, and a warm welcome to all of you on behalf of Hinduja Global Solutions for joining us for the conference call. I'm sure all of you've got the earnings deck that we have posted on our website, and I'm going to refer to that as I take you through my takeaway from this quarter's performance. So going to slide 3, you will see that the retained business, so we've made one segregation. With the healthcare business being divested, we are now showing you the performance of the remaining business as well. And since most of the year has been a combination of two businesses, and even Q4 had about 5 days of the healthcare business after the divestment of Jan 5th. So some of these numbers will be a little difficult to interpret, but bear with us, we'll try to see how best we can provide you more clarity on those numbers. So just on quarterly revenue performance, you will see that the retained business has actually grown very handsomely from 7,620 rupees million to 8,625 rupees million, a growth of about 13.6%. Whereas on an overall basis, the numbers pertaining to our business is 15,636, coming down to 9,144. And this is where I think you will be able to figure out that Q4 compared the consolidated business Q4 is showing a lesser number than the number last year. That is because it only has 5 days of our healthcare revenues in the right-hand side of that particular graph. If you were to look at the March revenue, if you were to look at the YOY revenue performance, then the retained business has actually grown even better. It's grown from 26,018 to 32,637 million rupees, a growth of about 25.4%, which is a very, very handsome growth. Whereas the growth numbers are more muted on a consolidated basis for the full year, 58,889 million rupees to 57,959 million rupees. That constitutes a 3.7% growth, and the explanation for the muted growth is the fact that the healthcare business in Q4 contributed only 5 days of revenue. We'll move to the slide 4, which talks about the Q4 in a little different perspective. In rupees, it's showing a 13.6% growth in revenues, slight dip in Ebitda, about 69.5% dip in Ebitda, and there I want to explain what exactly has happened. Why the numbers are looking like this. A large part of the transaction costs and pertaining to the healthcare divestment have actually been absorbed in this quarter, and that is what shows up in the set of numbers. PBT has grown actually from minus 176 to 473, and profit after tax marginally negative from minus 106 to minus 6. But overall improvement in Q4 numbers for the rest of the business. If you were to look at it from a full year perspective, you will see that the numbers are actually quite good. 25.4% growth in revenues, 46.1% growth in Ebitda, 133.1% growth in PBT, and 105.2% growth in profit after tax. This is for the full year. You will see that the profitability numbers on a full year basis have actually shown a good improvement. More details on these numbers will be covered by the financial section by Pala, so I'm going to move on and give you an overall view of the business in my presentation. This slide, which is slide 6, talks about the overall business for the full year, including the divested healthcare business. 3.7% growth on revenues, 15% degrowth in Ebitda, 1511.6% growth. That's because of the large amount of sale proceeds, money that has come in towards the sale proceeds of the business. That reflects in the PBT line, and a 16.3% growth in profit after tax. That again, the numbers are so spectacularly better just because of the sale proceeds for the healthcare business that are reflected in the Q4 number. Moving on to slide 7, the healthcare business. This is the last time that we are going to talk about healthcare because the business has been divested. It was divested to unlock significant shareholder value, enterprise value of 1.2 billion subjected to closing adjustment, effective 6 Jan 2022. 40% of the purchase consideration was received in India, rest has been received overseas. The profit before tax gave 65,543 million, out of which taxes were 801 million, giving a profit after tax of 64,742 million. That is slide 7. What we are left with is now the rest of the business, which we call the consumer engagement solution business, that has shown strong growth. The growth has been principally led by UK and US geos, both onshore and offshore. Of the two businesses, the UK business has seen a spectacular performance in revenue and profitability. The year-on-year revenue growth was about 36.5%. Ebitda was about 3.8 times the Ebitda for last year. One of the largest wins for the AGS public sector team, potentially a total contract value of £211 million, rupees 2,100 crores, employing over 2,000 work-at-home positions across UK, principally around vaccination support, test, track and trace support for COVID. I also want to mention another significant activity that happened in Q4, which is acquiring a diversified offshore Australia business that happened effective February 25th. Integration is in process as we speak. It is going on well. It's got a healthy sales pipeline since acquisition. We signed 6 new clients across retail, power and utilities, banking and financial services, etc. Moving to slide 9, the digital business. This is based out of the US. Its revenues grew by about 28.2% year-on-year. Multiple clients were signed up in the year, beginning offering cloud-related offering cloud-related services to a large multinational. We are because of confidentiality reason not able to share the names. We see a great demand for digital solutions led by cloud and the AAA of analytics, automation and artificial intelligence. 2 internally developed solutions was delivered to the market for the digital business. One is the Cloud Accelerator and another one is AGS Agent X. These are platforms built by AGS and a proprietary platform which we believe will give us great competitive advantage in the digital consumer engagement solution space. Moving to slide 10 captures what is the business that is left. We operate now in 7 countries with 38 delivery centers, $438 million in revenue, about 750 digital transformation consultants, 22,000 employees. The number of clients on the BPM side is 200 plus, and in the HRO and the payroll services, which is the India business that we run, that has got 730 clients. We have given a total dividend in FY 2022 of rupees 245 per share on a pre-bonus basis. We support 17 languages globally. Moving to slide 11, a peek into the future of this business. I wanted to show you some data that we have presented out here from Everest. We are talking about servicing the digital customer experience market. That is what CXM means. The outsourced market size and its growth potential from 2017 to 2022, those have been shown out here. You will see that the market is large. It is a range of about $96 to $98 billion. And of which the digital customer experience management, which is the target of AGS, has been growing steadily from 3.5% CAGR to 4.6% CAGR as we talk about the estimates for 2022. Despite the effects of the pandemic, the market is expected to really grow fast. 4.6% of a $96 billion is a large market. Digital demand is driving, led by aggressive client activity. The deals are getting bigger, and there is a lot of work in digital customer experience transformation projects, more about personalization and end-to-end managed services. AGS has been recognized by Gartner. Happy to say that this happened in Q4. If you look at it, both on completeness and vision and ability to execute, we rank in the leaders quadrant in Gartner's Magic Quadrant. We're very proud. This is the second consecutive year that AGS has featured in the leaders category in Gartner's Magic Quadrant. Very, very proud of this achievement. This is where we are today. Going forward, what do we want to do? Become a digitally led customer experience transformation company. Significant part of our work today is labor arbitrage driven, but we want to drive towards technology arbitrage. And to do that, we have to be able to scale our digital CX capabilities in artificial intelligence, analytics, and automation. Cloud, mixed reality for metaverse, leveraging our base book of the retained business. More strategic and tuck-in acquisitions to create a comprehensive digital capability and expand market, and focus on specific industry verticals, micro verticals, determine where to play and how to play. 3 pillars for the future: generating significant growth, achieving operational efficiencies to improve profitability, and focusing on successful M&A. So these are the 3 pillars on which we are going to build the company for the company. Slide 15, slightly more detail of the strategy they want to. The domains that we want to capture are marketing, payments, technology, data and analytics, and process management. So this we would claim to be a full-service digital customer experience transformation services partner for our clients. Our chosen verticals to play in would be banking and financial services, direct to consumers, retail and retail, technology, media, telecom, non-digital or fast-growing tech companies, and the public sector. And we will operate across strategy and design, technology implementation, managed services, analytics, and insights. With the service offerings being digital customer engagement, digital experience management, cloud and security, analytics and insights, and intelligent automation. A large part of our growth in the future will be driven by technology partners. We have deep partnerships with Microsoft, Adobe, UiPath, AWS, Twilio, Automation Anywhere, and Sprinkler. This is going to be the basic platform on which we are going to build AGS 2.0. With that, I'm going to hand over this presentation to Pala. Over to you, Pala.
Thank you, Partha. Good afternoon, good evening, everyone. Thank you for joining this call. Before I start covering the financial section, I wanted to check, are you able to hear me clearly? Hello, can you hear me?
Yes, we can hear you.
Okay, thank you. So I will now move to the next slide, which is slide 17. This is the quarterly view of the retained business. As Partha mentioned earlier, on a sequential basis, revenue growth has been 7.8%, and year-on-year growth has been 13.6%. In dollar terms, of course, it's about 10.4% given the depreciation of the rupee against the dollar. Ebitda margins for the quarter are muted. As Partha mentioned, there are several one-off costs during the quarter, including the cost related to the transaction of both the sale of the healthcare business as well as acquiring Divesting, which happened during the quarter. So the margins for the quarter of the retained business do look muted. The only other thing to call out is on the exceptional items. There was a query last quarter as well. This pertains to the healthcare business, which the buyer has not taken over. So from an accounting point of view, this is more a classification issue being shown as part of the retained business, though it actually belongs to the healthcare business. Anyway, as you can see, there is a big drop compared to quarter in December and March 21. So going forward, we don't expect this cost to continue. On a PBT basis, there has been an increase of about 368% on a year-on-year basis. And at a PAT level, the growth has been roughly about 93% on a year-on-year basis. Moving to slide 18, this is the view of the retail business. Again, if you see very strong growth, about 25% in dollar terms and 25.4% in rupee terms. The variation primarily because of the rupee depreciation, especially in the fourth quarter of FY22. Ebitda margins, while they may look low, this is to be noted. This has come on the growth of 24.4%. And in rupee terms, Ebitda has actually expanded about 46% over FY21 for the retail business. As we mentioned earlier, there are certain one-off costs which are there during the course of the year relating to the transaction mentioned and some one-off items. At a PBT level, revenue profit before tax has changed significantly from minus 1129 million to profits of 373 billion. And at a PAT level as well, from a loss of 586 million, it has now turned positive at 31 billion rupees for the retail business. Going on to the next slide, slide 19. This is a view of our balance sheet. We are a company with a net worth of about 78,084 million rupees. Book value per share is at 1,868. We have issued effectively 245 rupees per share as dividend on a pre-bonus basis. Because of the bonus, it would come to about 220 rupees per share. The other thing to call out is that we're virtually a zero-debt company. Total debt is 35 million. There's been about half of the debt has gone away after 31st March. And the balance amount technically shows up as a debt that's actually borrowed against fixed deposits of the company. Again, as you see, the amount is not material, not very big. And in a manner of speaking, we are truly a zero-debt company for 31st March. We have 35,209 billion of cash and cash equivalents. And we have net debt. We're a net cash company of 35,175 million rupees. Moving on to the next slide, we have, as of 31st March, as I said earlier, 35 million rupees as debt. We have ICDs to related parties of 11,445 million. We have cash of 35,209 million, and there are additional debt in investments in debt of roughly about 24,668 million rupees. Moving on to slide 21. This is the variations on some of, these are some of the other key parameters. Capex for the year was 2,371 million as compared to 1,581 million in the previous year. That is primarily because of extra capex required as we have grown, as we said, over 25% on the retail business. Also, due to the sale of business, there was some extra capex required to be incurred on a go-forward basis to help sort out, to segregate the facilities, the IT infrastructure. In terms of DSO days, there is a substantial reduction. For FY21, it stood at 72 days as compared to, so that is for the total business, healthcare and the CES business. For FY22, we have taken revenues DSO days as of 31st of March. That primarily pertains to the CES business because the healthcare business receivables were sold when we completed the transaction. And so the DSO days for the CES business as of March 22 is substantially lower at 65 days compared to 72 days, so roughly about 10% lower in terms of number of days. In terms of Ebitda to free cash flow conversion, this is for the company as a whole, including the healthcare business as well as the retail business. We have continued to operate well. As you see, the Ebitda to free cash flow conversion, which was about 43% for FY21. On an overall basis, has gone up to 48%. So obviously, the Ebitda has come down in absolute terms because of the sale of the healthcare business during the course of the year. And these cash flows are purely from operations after working capital and changes and capex, and do not take into account any cash flows from the sale of the business, sale of the healthcare business. Moving on to slide 22. You will recall in the month of on January 14th or so, the board had indicated to do a buyback of roughly about 1,000 crores, subject based on the audited balance sheet of the year. The actual number comes to 975 crores or 9,750 million rupees. If you look at slide 22, it shows how this number has been arrived. It's as per SEBI guidelines and Companies Act. It's the lower of the consolidated net worth and standalone net worth. In our case, the standalone comes lower than the consolidated. So looking at the total free reserves, and if we apply 25% of the net worth, which is the maximum amount permissible as per Companies Act and SEBI guidelines, the amount comes to 9,750 million or 975 crores as compared to the earlier estimate of 1,000 crores in estimates done in January. One thing to bear in mind, after the indication given by the board and the announcement made in January, we've actually declared 28 rupees interim dividend in February along with the Q3 results. So there was an outgo of about roughly 56 crores during Q4. If that had not been done, about 25% of that, so roughly about 14 crores would have got added just to do the bridge between 975 crores and the 1,000 crore ransom. So the 14 crores is the impact of the dividends which were paid out in the year during the course of quarter 4. Moving on to next slide. This is a quick, I'm on slide 23. this is a quick recap in terms of what's been done for the shareholders. We have announced roughly about 195 rupees dividends per share, 195 rupees per share of dividend in the form of interim dividends. And then we have announced, based on the board meeting last of Sunday, a final dividend of 25 rupees, which is of course subject to normal shareholder approval. So 25 rupees is, to be noted, is on post the 1:1 bonus. So on a pre-1:1 bonus basis, the dividend for Q4 should be seen as 50 rupees per share, and the total dividend paid out by the year is about 245 rupees per share on a pre-1:1 bonus basis. So roughly about 512 crores or 5,120 million rupees is the outgo on the dividend, taking into account the final dividend, which will be done around end September, subject to shareholders' approval. As I mentioned earlier, the amount of buyback based on FY22 audited financials comes to 9,750 million rupees. The detailed buyback process announcement would come at a later stage. Moving to slide 24, this is again for the retail business for the full year. In terms of revenue by delivery, with the sale of the healthcare business, US accounts for about 34%. You would see UK, which has grown, as Partha mentioned, significantly during FY22, now accounts for about 26%, followed by Canada, which is about 17.7%. The India business is now fairly small. This is about 13%, comprising of our HRO business and some of the digital business and some business which we do to service the offshore clients. From an origination perspective, the largest share continues to be USA at 38.4. UK comes next at 31.5, followed by the Canadian business as well as the India business, which stands at 10%. This is revenue by origination. Moving on to slide 25, revenue from verticals. This is for FY22, excludes the healthcare business. As you would see, the largest is what is coming primarily from UK, but we do have some other countries as well. Basically, that's public sector and some others, other verticals. After that, it is telecom and technology, which accounts for about 20%, followed by about 19%, which is consumer and services. And we have banking and financial services, which account for about 18%. Moving on to slide 26, which is the slide on client concentration. The healthcare business had significant client concentration, with the largest client accounting for close to about 40%. But the sale of the healthcare business for the retail business, the key clients account for about 10%, top 5 about 39%, and top 10 customers account for about 52%. On the retail business, we talked about the strong growth on the digital business. So now digital accounts for about 11.6%. About non-voice back office comes from non-voice back office and business, and the balance 77-78% comes from the retail business. Coming to as an update on slide 27, an update on the transaction with Next Digital. This is a transaction by which the board of SGS and Next Digital have approved. From a structure point of view, it's the demerger of the Next Digital media and digital business into SGS. The consideration will be through issue of shares to the shareholders of Next Digital. That when for every 63 shares held of Next Digital. The shareholders of Next Digital will get 20 shares of HGS. Post the approval from the board, filings have been done with the stock exchanges. This requires approval from SEBI. Thereafter, we require approval. I have to go through the NCLT process. So we are right now in the process where the approvals are awaited. On some, as and when we get the approvals from regulatory authorities, shareholders, etc., when the transaction goes through, the share capital of HGSL will increase from 41.97 million shares. It will go up to 52.48 million shares. So there is about a dilution, increase of share capital by about 20.4% to issue of additional shares to the shareholders of Next Digital. And based on the last available information on the promoter shareholding, there will be a small drop in the promoters holding from 67.1% to about 64.7%. Moving on to slide 28. This is the share price movement compared to CMX IT as well as listing. This takes into account and is normalizes for the 1:1 and the issue of when the share price and X bonus on 22nd February 22. So this is relative to CNX IT as well as Nifty price. The share price as end of today was roughly about 950 rupees at close of business today. That's all from my side. Now I hand it back to the moderator and we will take up the Q&A session. Back to you, Snyder.
Thank you. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touch tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use the handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. Congrats on the decent set of numbers for the Q4. My question, firstly, on the healthcare side, like after the divesting the healthcare service business, is company looking to expand any other segment?
Yeah, so we are, I think we mentioned that in our presentation, we are looking at fast-growing tech, we are looking at e-commerce and retail. We are also looking at technology, media, telecom, and banking and financial services. Okay.
And so, what are the strategies that companies are adopting to build the HGS 2.0 level? And how much, we are expecting margin going forward, and what will be the revenue growth for the FY23-24?
Yeah, we will not be able to give you forward guidance. I think in one of the presentations slides that we had shared, we did cover the strategy. If you go back to slide 15, we have tried to cover that in fair amount of detail. So I would request you to go through that slide, because I did try to cover it in my presentation. In terms of margin profile, the idea would be to build it back to the level of profitability that we had before healthcare was a part of our business. And as we add more technology businesses generally are supposed to be able to generate better margins. So we would try to improve our profitability going forward.
Okay.
So I would request you to look at slide 15 that explains our strategy in one page itself in fair amount of detail.
Yes, I got that, sir. And sir, recently company has did the acquisition of Next Digital Limited. So any other acquisition in the pipeline?
We acquired a company called Diversified Offshore Solution in Australia. That also happened in February 25th.
Okay, if you can guide.
Next Digital is a merger. It's not an acquisition. It's a merger, and the scheme has still to be approved by the regulators. So it is not yet complete.
Okay, so how much time it will take?
It will take some time. I don't have a specific timeline. It's a function of how the regulators take time.
Okay. And sir, you have mentioned about the buyback, but detail still you will announce further. So any light on the buyback?
Yeah, the buyback cannot happen till the merger is over. So once the merger is completed, only then the buyback can happen. So I would say tentatively towards the end of this calendar year is when the buyback can happen. And the details of that can also be shared only after the merger process has been completed. So further details we cannot give. We have given you all the details that we could, which is the quantum of the buyback, 975 crores has been shared with you by Mr. Palakudetti. Beyond that, any further details, you will have to wait till the merger is over.
Okay, fine. Thank you.
Thank you. Next question is from the line of Ruchika Sharma from Wealth First Advisor. Please go ahead.
Thank you. Congratulations for a good set of numbers. My first question was with regards to our healthcare business. So approximately, sir, how much time are we expecting to take to fill the gap created by divesting this healthcare business?
I would say it will take us approximately 3 to 4 years.
Okay. Right. And also, sir, amongst the other segments that we have, like, public sector, telecom and TMT business, where do we plan to focus more and where do we expect to receive larger revenues from?
Public sector is the one that I would say would be our focus for this year at least.
Okay, great. Also, so my second question is with regards to our digital space. Which type of mandates are we targeting in this digital space, and are we having any prominent names of companies that we are catering to? Because in the last quarter, the management mentioned about winning a multi-million-dollar deal from a global tech company. So could you just disclose a few details on that end, please?
No, so that is the problem. We can't give you the name of that particular company. It's a large deal. It's a very well-known technology company worldwide. And beyond that, we are not able to share more details.
Okay. That's it from my side. Thank you, sir. All the best.
Thank you.
Thank you. Next question is from the line of Rutvik, an individual investor. Please go ahead.
Good evening, sir. Thank you for the opportunity. I have a couple of questions. From the funds that are available for deployment, how much of that will go into organic and inorganic in value terms or percentage terms?
Yeah, again, that's not a number that we are disclosing as of this point of time. It's something that will be a function of what opportunity comes in front of us, what makes sense from a long-term strategic perspective. But I have to say the large part of the funds will be deployed for both organic and inorganic. And we want to make the company a technology company. And therefore, the focus of our acquisitions for the future will be on acquiring technology companies.
Okay, fair enough. The second question is, could you just elaborate on this partnership between Digital and Khoros?
And Khoros?
Yes.
So it's not just Khoros. Khoros is just one of the partnerships. There is, I think what you have mentioned is Sprinkler, right? I don't think you have mentioned Khoros. 1 minute. If you look at slide, if we talk about Khoros, we do have a partnership with Khoros, but we haven't mentioned Khoros. Where are you seeing Khoros? On slide 15, we have talked about Sprinkler. It's similar. Khoros is similar to Sprinkler. It's basically...
it's in the press release, sir.
Okay, got it. Yeah, so Khoros and Sprinkler is similar. It basically is a tool that enables you to go through all the social media content that gets created and track reputation of firms, what are companies talking about specific brands and other things. It's a reputation management tool. So yeah, that is a new partnership that we have started this year, and these partnerships are going to enable us to provide a differentiated customer experience management capability.
Okay. Thank you so much, sir. That's all from my end.
Thank you.
Thank you. Next question is from the line of VP Rajesh from Banyan Capital Advisor. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question was regarding the transaction expenses. Could you comment on that and tell us the quantum of the fees that was booked in the Q4 quarter and anything that will be booked in Q1?
Pala, you want to take the question on transaction expenses?
Yeah. So the transaction expenses totally is about 2,438 million rupees. That is lawyer fees, etc. I think we don't see anything spilling over into Q1 of FY23 because the transaction has been completed. Sorry? Was it a follow-on question?
The line of the participant is disconnected. We'll go to the next participant. Please give me a moment. The next participant line is Mr. Shailendra Mundra from Vaibhav Financial. Please go ahead.
Hello.
Hello.
Hello, can you hear me?
Yes, we can hear you.
Yeah, hi. Thank you, sir, for a very good explanation of your business and the financials. So, what I've noticed is, on a normalized basis, it appears that your retained business is at best about 3% Ebitda business as of now. So could you please give us any idea about how or if you would be able to improve the margins and substantially compared to your other peers in India?
That's a very good question. Our principal focus this year would be to make our real estate footprint more, to shrink our real estate footprint. As you know, a large part of our business after COVID has moved to work from home. And so therefore we are stuck with many leases and properties which we own or lease today, which are not required and people are not working from those places. So we are trying to see how many of those leases can we exit from, how many of the real estate can actually be sold out. That could be a course of lowering our operating expenses. These are large numbers, obviously. When I saw that talked about 38 operating centers, right? Most of these operating centers are vacant today. And while some of these are owned properties, there are some which are lease properties and there are lease rentals that we are paying today which actually are not being used. So we are exploring options to see how we can exit some of these leases and how we can sell off some of these properties. So that's going to be a big chunk of what we're trying to do to increase the margins of the business. The second lever we will try to pull is we're trying to see how we can improve the revenue profile by improving our digital capabilities and selling technology services in larger this thing. Today, if you see our revenue distribution is about 11% is digital revenues. Over the next 3 years, we see that our digital revenues will grow to the extent of becoming almost 50-50 of our labor arbitrage business and our digital business. As that happens, we will see the margin profile improve.
Okay. So, are you saying that post-COVID, you will not need to get those employees, the voice employees, back into offices?
Look, the outlook is, as of now, is that onshore people are still okay to work from home. There is some pressure to bring people back to work in Philippines. India, we are still allowed to work from home. So we are watching this space to see whether we really need the kind of, real estate footprint that we have today. The future of work is going to be a hybrid model of work from home and work from office. And therefore, we need to rationalize our real estate footprint.
So, and can you please give us some idea on, what is the EBITDA margin in digital versus voice versus the other part you mentioned, the non-voice?
Yeah, so that is a good question, sir. Unfortunately, we don't disclose that number in our published financials. It's something that we can look at in the future, whether we want to disclose those details. But right now, I'm not in a position to. So
maybe you don't disclose it for your company, but in general, in the market, what is the general observation? Since you are targeting digital, what kind of EBITDA profile it has versus the voice?
Technology companies, the EBITDA profile would be in the mid-teens to high teens. Okay, and some even have EBITDA of in excess of 20%.
Yeah. This is another question I had. I was wondering, you have sold the best part of your business, actually at a very good price, so that's a good thing. But the question is, would you, since you have good experience in that business and you have scaled it up before, would you like to get into similar business, acquire small parts and, scale up again, or not? Or is there any non-compete agreement there?
Yeah, there is a non-compete. We will not be able to get into the healthcare space again.
Okay. Thank you, sir. Thank you for your answers.
Thank you.
And all the best.
Thank you.
Thank you. Next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Hi, sorry my line dropped earlier. I was asking you about the next digital transaction. So in that situation, when we are issuing the shares, are we acquiring the entire company or only a portion of that company? It's not very clear from your comments in the press release.
Hala, you want to take that question?
Yeah. Thank you, Rajesh. Thank you for joining back. To clarify, we are only acquiring the media and digital business of Next Digital and not the entire company.
Okay. And for that you are, okay, understood. All right. And then in terms of the ICDs, what is the maturity profile of them? And are you planning to do more ICDs to the related parties in this current year?
Look, these are all which are, repayable on notice, short notice. So they're essentially money deployed on demand. And the maturities are all, maximum 1 year from the date of disbursement. So everything will fall due before 31st of March 2020. And, based on as and when we need the funds, we can call the money back by giving it.
Right, but is there any plan to reissue these ICDs as they mature this year?
So, look, there are obviously money required for the buyback as and when we do. There is also organic growth and money required for acquisition. So right now we are able to earn better rates, interest rates than what we get through putting in cash deposits. And this is money available, made available to related parties and can be called back as and when funds are needed.
No, I got that point. I was just trying to understand if you will reissue to them. That's all I wanted to understand. Let's say they mature on 31st of December, and in that case, would they be reissued, or this was a one-time deal with the related parties?
Yeah, look, it depends what is the position as on the day and what is the deal we can get. And we'll obviously use up the lowest interest cost bearing funds first and call back the funds as in the required from ourselves and IT. It's a treasury management exercise.
Okay, understood. And then on the business side, how much cash would you need for working capital purposes? Because obviously you are profitable, so the only cash you may need is for
look at it,
working capital.
Please complete your question. Sorry, I interrupted.
No, I was just saying that, in fact, even that you may not require, because what you said about disposing of real estate, then you might have cash proceeds coming from that side also. So I'm just trying to understand if you will be using the cash that you have on your balance sheet for any purposes in the business this year.
Yeah, so we would require, if you're growing, you would require cash because money will get locked up in working capital. So right now the DSO days is roughly about 65. There would be CapEx and there would be any M&A which we do.
Okay, so what is your CapEx guidance for this year?
We are working through it because, the CapEx requirements change based on how much is going to be work from home and how much is going to be in office. We're working through that.
Okay.
And also, migration has been towards, wherever possible, on cloud-based technologies, especially on the telephony, those kinds of infrastructure, rather than the traditional servers, on-prem servers. So it's a mixed bag, but we are working through that.
Understood. Thank you so much. All the best.
Thank you. The next question is from the line of Shailendra Mundra from Weber Finance of LLP. Please go ahead.
Hi, sir. When I look at your cash, you have almost 7,000 crores of cash. And after dividend and buyback, you will still be left with almost 6,000 crores of cash. So, and because of the limitation of buybacks that you cannot do more than about 1,000 crores in a year, so you will have to aggressively deploy the cash to get some reasonable return on this cash hold. So what is the plan? Is there any intention of going for some aggressive acquisitions or making some investments in other good companies? If you invest this in fixed income securities and that too with the current interest rates, the tax rates, etc., there is not much you can get out of it. So could you please detail your vision, at least a high-level vision of what you plan to do with this cash?
So you would see that within a few weeks of selling our business, we acquired a business in Australia. So that was the first one that we did, and within a few weeks of that, the merger. Even though the merger is going to be a share swap, it is not going to be cash. So the short answer to your question is we need to acquire digital capabilities because this is going to be a technological company. Therefore, we are going to deploy most of the cash that we have in our books today to build that capability, either build organically or build through acquisition in the technology space. So that is the vision for utilization of this cash.
Okay. So if you get opportunities, you would like to invest all that 6,000 crores in acquiring new companies or capabilities or businesses?
That is correct.
Okay.
So till such time we get a concrete opportunity which is good, the money is parked in short-term securities in ICT.
Okay. Thank you, sir.
Thank you.
Thank you. Next question is from the line of Avinash Nahata from Parami Finance Services. Please go ahead.
Hi, thank you for the opportunity. In response to one of the participants' question that you would vacate some of the current leases. So I have a query here. So assuming those all the employees were occupying those leases or those offices, our margins would be 3%. Is that correct?
Yeah, so that is the current number, yes.
Yeah, so now the second question is there a spare capacity also as far as the number of seats are concerned, or that's not the case?
Yeah, there is spare capacity, yes.
No, so spare capacity could be 10%, it could be 40%. So any magnitude, because you said that the vacating of lease would lead to a substantial rise in EBITDA margin. So the idea to understand is basically two things. One is so you spoke about one is vacating of lease and second is ramping up as far as the new clients or new businesses are considered. So from a shareholder perspective, we just want to understand that when can we see the ramp up as far as the new business is considered in 1 quarter, in 2 quarters, and margins at least 7 to 8% margin in 2 quarters, 3 quarters. Give us some sense directly.
Towards the end of this year, towards quarter 4, you will probably see a significant improvement in margins.
Okay, so you're saying another 3 quarters time.
Yeah, approximately, yes.
And this UK business which you have spoken about, that is classified under the government business, right?
Correct. It's a public
and the ramp up of which will start, or has it begun?
Yeah, it has begun.
And you spoke about 2,000 crores over 2 years, is it?
It is 211 pounds.
Yeah, sorry, 200 plus million pounds over 2-year period.
Yeah, it is 2 plus 1 plus 1.
Okay. Yeah, that's all from my side. Thank you.
Thank you.
Thank you. Due to time constraint, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Srinivas Palakodeti for closing comments. Please go ahead.
Good evening again. Thank you everyone for joining on our Q4 and FY22 full year financial discussion. We look forward to meeting with you again in a couple of months' time to discuss our results for Q1 of FY23. Thank you once again for joining this call. Good evening and have a good day.
Thank you. On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.